Welcome back to Dreamlit Equity Research. Today we're covering a company I think is widely misunderstood. Robinhood Markets, NASDAQ, HOOD. Most investors still picture the 2021 version. The meme stock app that restricted GameStop trading got dragged before Congress and lost 2/3 of its value within a year of its IPO. That version is gone. Here's what Robinhood actually looks like in June 2026. FI 2025 revenue, $4.5 billion, up 52% year over year. Its first fully GAAP profitable year, with $1.88 billion in net income, 27 million funded accounts, 4.3 million gold subscribers, $68 billion in net new deposits in 2025 alone, platform assets over $350 billion. It's launched agentic AI trading ahead of every incumbent broker, closed a Canadian crypto acquisition, is building a tokenization layer on Arbitrum, and has a U.S. government partnership to onboard new investors through Trump accounts at essentially zero acquisition cost. This is a different company than the one that IPO'd in 2021, and the market hasn't fully caught up. Over the next half hour, we'll move through the research note: business model, financials, product roadmap, M&A, competition, red flags, valuation, and price targets. This is a research note, not financial advice. I'm not your financial advisor. Do your own diligence. Let's begin.
30 seconds on the disclaimer because it matters. This is for educational and entertainment purposes only. I'm not a licensed financial advisor, and nothing here is financial, legal, or tax advice. These are my own opinions, and they can change as new data arrives. Do your own research and consult a qualified professional before making any decisions. Legal house in order. Let's get into the numbers. This is the dashboard slide. And there's a real disconnect here. These are the numbers of a company that's genuinely transformed, yet its $82 billion market cap hasn't fully caught up. FI 2025 revenue, $4.5 billion, up 52% year over year. A growth rate you'd expect from a hyper-growth SaaS company, not a regulated brokerage, and it's happening alongside full GAAP profitability. Net income, $1.88 billion. Versus a loss of $541 million in FI 2022, a $2.4 billion swing in 3 years, and this is GAAP, not adjusted. Diluted EPS, $2.05, a record. One honest caveat: Q1 2026 revenue of $1.07 billion came in softer sequentially than Q4 2025, with crypto revenue showing particular weakness. We'll come back to that in the red flag section. Gold subscribers, 4.3 million, up 36% year over year, at roughly 16% penetration of the 27 million funded accounts, meaning 23 million plus customers haven't subscribed yet. That's the growth runway. Platform assets, over $350 billion. Net margin, 41.1%, world-class for fintech. 52-week range, $63 to $154, with shares around $90 today. The central question of this whole case: is Robinhood a reformed meme stock app that got lucky in a crypto bull cycle, or a genuinely durable, multi-product financial platform executing one of the more impressive turnarounds in recent fintech history? That's what we're here to help you answer. 2013, Stanford roommates Vlad Tenev and Baiju Bhatt, both with high-frequency trading backgrounds, set out to kill the $7 trade commission. A waitlist of over 1 million people forms before the app even launches. 2015, the app goes live, funded invisibly by payment for order flow, free trading paid for by Wall Street. 2018, crypto and options trading added, 6 million accounts. Regulators start watching closely. 2020, the COVID meme stock era, 13 million accounts. A March outage sparking a $70 million lawsuit. Then January 2021, Robinhood restricts trading in GameStop and AMC at the exact moment retail investors are most engaged. Congress summons Tenev. The brand takes real damage. July 2021, IPO at $38 and the stock craters. By 2022, it's down 85% from IPO, revenue down 25%, and 23% of staff laid off. That's the bottom. What happens next is the interesting part. Instead of pivoting into banking or trying to become SoFi, Tenev doubles down on the core product and stacks new revenue pillars on top. 2023, Gold subscription launches, 24/7 trading begins, 2 acquisitions. Ziglu for UK crypto and X1, later rebranded the Gold Card. 2024, credit card launch, index options and futures, the AI-powered Robinhood Legend desktop platform, and the $200 million Bitstamp acquisition bringing an EU crypto license. 2025, Robinhood's first fully GAAP-profitable year, $4.47 billion in revenue, 4.2 million gold subscribers, $218 billion in platform assets, plus the $300 million trade PMR acquisition for RIA custody. 2026, Agentic AI trading launches, the first regulated broker to offer it, alongside the WonderFi Canadian crypto acquisition, tokenized stock development on Arbitrum, and the Trump Accounts partnership. 3 structural advantages come out of this history. A genuinely mobile-native product rather than a retrofitted one, a first-mover position in agentic AI, and the gold subscription flywheel. The platform's highest ARPU, stickiest customers, growing 36% a year. For revenue pillars, each with a different risk profile. Pillar 1, transaction revenue, about 66% of FI 2025 revenue, $2.38 billion. Options PFOF is the largest single line at roughly $1.26 billion. Robinhood routes options orders to market makers for a rebate, and it's also the biggest regulatory risk on the platform. Crypto made up over 35% of Q1 2026 net revenue, but is highly cyclical. It collapsed 90% in the 2022 crypto winter, and Q1 2026 already showed renewed weakness. Equities PFOF is the smallest slice, around 12% of transaction revenue, and faces the most regulatory scrutiny globally. Pillar 2, net interest revenue, about 28% of revenue, $1.45 billion from margin lending, cash sweep, and securities lending. This is highly rate sensitive. A return to near zero rates could cut this by 50 to 70%, or $720 million to over $1 billion. Pillar 3, gold subscriptions. Only about 6% of revenue today, roughly $270 million annualized, but it's the line I'm most bullish on, growing 36% a year at 16% penetration, rate independent, and driving 3 to 5 times the ARPU of a standard user. If gold reaches 8 million subscribers by 2028, that's a $670 million recurring, high-margin business on its own. Pillar 4, emerging products. Prediction markets under CFTC regulation, FDIC-insured banking through gold, and Trade PMR's RIA custody business with $40 billion in assets under administration across 350 advisor firms. The bridge from Robinhood's retail app to serious wealth management as its customers age. This is the financial spine of the thesis. Revenue, $1.36 billion in FI 2022, growing to $1.87 billion, $2.95 billion, and $4.47 billion by FI 2025, a compound growth rate over 48%. FI 2026 is estimated at $5.10 to $5.50 billion, or 14 to 23% growth. The law of large numbers is starting to matter, though $1 billion of incremental revenue in a year is still not trivial. Net income tells the sharper story. Negative $541 million in both FI 2022 and FI 2023, then a $495 million inflection in FI 2024, and $1.88 billion in FI 2025, a $1.4 billion jump in a single year, almost entirely from operating leverage rather than cost-cutting. Net margin hit 41.1% in FI 2025. For comparison, Coinbase's best years ran 15 to 20%, and Schwab runs 25 to 30%. Adjusted EBITDA went from $128 million in FI 2022 to an estimated $2.5 billion in FI 2026, roughly 17x growth in 3 years. Gold subscribers grew from 1 million to 4.2 million over the same period, with 5.5 million estimated by end of FI 2026. This is the metric I watch most closely because it's Robinhood's clearest path to durable, recurring revenue. Platform assets went from $62 billion to over $350 billion, a 5.6x increase. And on valuation, diluted EPS of $2.05 puts the stock at roughly 44x trailing earnings, or about 39x forward. Not cheap, and it requires continued strong execution to justify. 8 products, 4 live, 2 expanding, 2 still in development. Live, prediction markets on elections, sports, and macro events, CFTC regulated. An early mover, though the total market size is genuinely uncertain. Live, the gold card, 3% unlimited cashback with no annual fee, which doubles as a retention tool since canceling gold means losing the card. Live, retirement accounts, with a 1% IRA match, no other major broker offers for free, aimed at turning trading customers into long-term wealth-building customers. Live, 24/7 market trading from 4 a.m. to 8 p.m., ahead of every incumbent. Expanding, crypto, now with 25-plus coins and post-Bitstamp, EU exchange licensing and institutional custody. Expanding, UK and European presence, still under 5% of revenue, but growing, which matters as U.S. regulatory risk increases. Developing, banking and checking through gold, targeting a July 2026 rollout, aimed at replacing Chase or Bank of America as customers' primary account. Not yet achieved, but the pieces are being assembled. Developing, Sherwood Media, in-app financial news and research meant to increase engagement and reduce churn. The same logic the Wall Street Journal uses for traditional investors. 6 strategic moves. February 2025, trade PMR for about $300 million. An RIA custody platform with $40 billion in assets under administration across 350 advisor firms, directly addressing the criticism that Robinhood's average account size is $8,000 versus Schwab's $350,000. June 2025, Bitstamp for $200 million, the oldest operating crypto exchange, bringing an EU license, institutional custody, and staking infrastructure. May 2026, agentic trading. Not an acquisition, but arguably the most consequential product decision since zero-commission trading in 2015. AI agents, including third-party ones via API, that can execute trades autonomously. If it drives even a 20% increase in trading frequency among active users, or if developers start building on Robinhood's API the way they built on Stripe, this becomes a platform business, not just a broker. June 2026, WonderFi, for about $250 million Canadian, a regulated Canadian crypto platform, extending the international crypto footprint. Also in 2026, proprietary tokenization on Arbitrum Layer 2, an internal bet on 24/7 on-chain trading of U.S. stocks in Europe. Tenev has called it the industry's biggest innovation in a decade. That's a bold claim, and it isn't CC approved yet, so treat it as ambition rather than a done deal. In Trump accounts, tax advantage accounts for eligible children with a $1,000 initial treasury contribution, where Robinhood is a distribution partner. If the program scales, it could add millions of funded accounts at essentially zero acquisition cost to Robinhood, since the government is footing that bill. 6 competitors, quickly, versus Charles Schwab. Schwab is bigger by almost every traditional metric. $140 billion market cap, $19.6 billion in revenue, 35 million plus customers, a branch network and advisor platform. But it doesn't have Robinhood's mobile native UX, crypto offering, agentic AI, or growing gold subscriber base. And as wealth shifts to younger generations who default to apps over desktop portals, that gap could matter more over time. Versus Interactive Brokers. IBKR owns the professional trader segment, with $5.3 billion in revenue and unmatched global reach. Robinhood isn't trying to win that fight, though products like Robinhood Legend are aimed at semi-professional traders in between. Versus Coinbase, the most interesting comparison. Coinbase is crypto native at $6.6 billion in revenue, but it doesn't offer equities. You can't buy Apple stock there. Robinhood, especially post-Bitstamp, can offer both in one regulated U.S. app, which is a real bundling advantage nobody else fully replicates. Versus SoFi, different bets more than direct rivals. SoFi has a bank charter and a lending business Robinhood lacks. Robinhood has crypto at greater scale, the agentic AI first mover position, and nearly double SoFi's account base.
Versus Webble, a credible player in the active trader segment at around $600 million in revenue, but lacking Robinhood's brand, scale, and product breadth. The overall picture: Robinhood's moat isn't any single product. It's the combination of mobile-first UX, crypto, AI, and a subscription ecosystem aimed squarely at the generation about to inherit the largest wealth transfer in American history. No competitor has matched that full stack yet. 8 risks, 2 of which I'd call potentially existential. Critical: a PFOF ban or severe restriction. The EU and UK have already banned payment for order flow outright, and US scrutiny continues. Options PFOF alone is about $1.26 billion in annual revenue, roughly 28% of FI 2025 revenue, with no product ready to immediately replace it if it disappears. Critical: crypto revenue volatility. This line collapsed 90% in the 2022 to 2023 bear market and represents over 35% of quarterly transaction revenue in strong periods. Q1 2026 already showed renewed weakness, and the cost base doesn't shrink when volume disappears. High customer concentration in the millennial cohort. Average account size is about $8,000 versus Schwab's $350,000, and it's genuinely improving whether customers stay as they age and accumulate wealth or graduate to other platforms. High gamification and regulatory reputation. The $70 million FINRA fine in 2021 is a real precedent, and Robinhood's pattern of launching fast and settling later has a limited number of times it can work before it becomes a serious liability. High interest rate sensitivity. Net interest revenue of $1.45 billion depends heavily on elevated rates. A return to near zero rates could remove $700 million to over $1 billion of it. Medium customer acquisition cost and churn. Funded account growth has slowed to around 8% year over year. Marketing incentives are expensive, and Robinhood doesn't disclose retention for non-gold users. A real disclosure gap. Medium agentic AI regulatory risk. FINRA suitability rules and SEC best interest standards weren't built for autonomous AI trading, and one high-profile AI trading failure could trigger action that shuts the product down. Watch a Supreme Court review of an IPO-era class action lawsuit alleging insufficient risk disclosure. Not yet a confirmed liability, but worth tracking. 3 beliefs all have to hold for the long-term bull case to work. 1. The Great Wealth Transfer is real, and Robinhood captures it. About $84 trillion is expected to move from boomers to millennials and Gen Z over 20 years, and roughly 80% of Robinhood's 27 million accounts fall in that 25 to 45 age range. If instead those newly wealthy customers move to Schwab or a fee-only advisor as their balances grow from $8,000 toward $800,000, Robinhood stays a starter broker people graduate out of. 2. Gold creates a durable, rate-independent income floor. At 4.3 million subscribers and 36% growth, this could become a $700 million to $1 billion annual business uncorrelated to crypto or rate cycles. But if the Fed cuts aggressively, the 5% APY that drives many gold signups loses its edge over ordinary savings accounts, and churn could accelerate. 3. Agentic AI plus tokenization is the next platform cycle. Robinhood is first mover in AI trading and is building proprietary tokenization. If this lifts ARPU from around $130 toward $300 plus and gets regulatory approval, it changes the valuation conversation entirely. But this is genuinely novel regulatory territory. One high-profile AI failure or a FINRA restriction could end the story before it starts, and better resource tech companies could build competing AI trading assistants of their own. Current price around $90. Market cap about $82 billion. Next earnings expected July or August 2026. Bear case, 12-month target $45 to $60. 33 to 50% downside. on 18 to 22x forward earnings. This requires several things to go wrong together. A PFOF ban removing $1.50 billion plus of revenue, a sustained crypto bear market, aggressive Fed rate cuts hitting net interest revenue, and agentic AI getting restricted before it scales. It's not an impossible scenario if 3 or 4 of those triggers hit at once. Base case, 12-month target $100 to $130, 11 to 44% upside, on 32 to 38x forward earnings. This needs FI 2026 revenue in the $5.10 to $5.50 billion range. Gold subscribers reaching 5.5 million plus. Net deposits sustaining $60 to $70 billion annually. And crypto stabilizing rather than collapsing further. This is the most probable positive outcome. Bull case, 12-month target $160 to $200, 78 to 122% upside, on 45 to 55x forward earnings. This requires agentic AI going mainstream, tokenized trading getting regulatory approval in Europe, gold hitting 8 million plus subscribers, and Trump accounts adding millions of customers at minimal cost. Analyst consensus sits at $98.77 across 27 analysts, ranging from a $52 fair value hold at Morningstar. Essentially the bear case, if AI and tokenization don't pan out, up to a $155 target from JMP Securities. That spread tells you how wide the range of credible outcomes really is here. At about $90, Robinhood trades around 45x trailing earnings and 32 to 35x forward FI 2026 estimates. Against peers, Schwab, at $19.6 billion revenue, trades near 22x forward earnings. The valuation gap reflects Robinhood's 50% plus growth versus Schwab's roughly 5%, and it's justified only as long as that growth holds. Coinbase, at $6.6 billion revenue, trades near 35x. Robinhood trades at a slight discount despite also having a full equities business, a gap that should close if agentic AI and tokenization prove out. Interactive Brokers, at $5.3 billion revenue, trades near 24x. Its professional trader mode is real, but it isn't growing at Robinhood's pace and lacks the consumer brand or subscription product. SoFi, at $2.7 billion revenue, trades near 38x despite lower revenue and growth in Robinhood, reflecting both the market's uncertainty around Robinhood's bear case and optimism about SoFi's bank charter. The key insight: Robinhood's premium is justified if gold growth sustains 25 to 30% annually. Agentic AI meaningfully lifts ARPU above $200, and net deposits keep coming in at $60 billion plus a year. The key risk is multiple compression. A stock price for growth can lose half its value on one disappointing quarter, even if the underlying business stays fine. This is not a safe, large cap holding. It's a high-octane growth bet with real risk in both directions. For things to watch every quarter: earnings metrics, Q2 2026 results expected July or August. Is revenue tracking toward the $1.25 to $1.35 billion consensus? Are gold additions holding their pace? Are net deposits sustaining 25% plus growth? And is ARPU on track toward $200 plus by year end? Any guidance raise is a positive signal. Any cut is a real derating risk. Product and platform: the July Robinhood banking rollout and early adoption. Any SEC or FINRA commentary on tokenized stocks. Funded account growth from Trump accounts. Trade PMR's progress towards $60 billion in assets under administration, and Bitstamp's contribution to institutional volume. Regulatory and policy: SEC action on payment for order flow is the single most important item to track, along with any FINRA guidance on agentic trading liability, how crypto regulation under the Clarity Act plays out, and the Supreme Court's handling of the IPO lawsuit. Capital allocation: whether the roughly $1 billion annual buyback authorization is being executed, how the $4.3 billion cash position gets deployed, insider selling patterns from Tenov and Bot, and whether adjusted EBITDA margin keeps expanding past 48% or starts compressing. The near-term catalyst to watch: Q2 earnings in July or August. If agentic AI general availability, the gold 5 million milestone,
and strong net deposits all land together. That's a real re-rating catalyst. If 2 of the 3 disappoint, expect the stock to test $70 to $75. The one-slide version. Thesis: Robinhood is pivoting from a meme stock platform into a full-stack financial app. Gold subscriptions, agentic AI, institutional crypto via Bitstamp, and RIA wealth management via Trade PMR, all converging on the demographic about to inherit the largest wealth transfer in American history. What's different? No other regulated U.S. platform combines equities, crypto, agentic AI, 24/7 trading, and RIA custody in one mobile-native product. What we like. $4.5 billion in FI 2025 revenue, growing 52%. $1.88 billion in GAAP net income at a 41.1% margin. 4.3 million gold subscribers growing 36% a year, $68 billion in net deposits, an incredible AI first-mover position, all following a genuine near-death experience in 2022. What worries us? PFOF ban risk to over $1.5 billion of revenue. Crypto's history of collapsing 90% in bear markets. A 45x trailing P/E that leaves little room for error, an $8,000 average account size versus $350,000 at incumbents, unsettled regulatory territory for agentic AI, and rate sensitivity on $1.45 billion of net interest revenue. Price targets: bear $45 to $60, base $100 to $130, bull $160 to $200. At roughly $90, the stock sits at the low end of the base case, above the bear case, and around half the bull case. That's the research note on Robinhood. NASDAQ, Hood. 5 things to take away. 1. It went from nearly bankrupt in 2022 to $4.5 billion in revenue and $1.88 billion in GAAP net income in 2025, one of the faster fundamental turnarounds in recent fintech history. 2. The gold subscription business, at 4.3 million subscribers and 36% growth, is the part of the story I think investors most underestimate. If it reaches 8 million subscribers, that's a $670 million recurring revenue business on its own. 3. Agentic AI and tokenization are the next chapter, and Robinhood is first to write it. But whether that becomes a durable advantage or gets regulated away is genuinely unresolved. 4. The risks are real: PFOF, crypto, cyclicality, rate sensitivity, customer retention, and regulatory uncertainty around AI trading. And none of them are hypothetical. Price in the base case, not just the bull case before building a position. 5. At around $90, the stock sits at the low end of the base case range. This isn't a comfortable investment. It's a high-conviction bet that the company that disrupted brokerage once can do it again. Execution will decide it. Do your own research, consult a professional, and let me know what risk you think I'm underweighting. Thanks for watching Dreamlit Equity Research. See you in the next one.